Alright, welcome to this video on the secrets to profitable stock investing and stock trading part 2. If you have not watched part 1, please pause this video, watch part 1 before continuing with part 2. Are you ready? Alright, let's begin. So in part 1 of the video, I shared the secrets to successful stock investing. And the main secret is all about investing in fundamentally great businesses. So again, what's a great business? A great business is one with consistent sales, profits, and cash flow increasing every single year. Great businesses are those with little or no competition. And like I said, in the entire market, less than 1% of companies are great businesses that are investable. So again, in investing, it's 90% fundamental analysis and 10% technical analysis. Now, when you pick a great business, you know confidently that over time, the business will increase in value. It will be more and more valuable over time. So you know that in the long run, the share price will always be higher. So in the short term, because of news and volatility and the price goes up and down, you're not too concerned. In fact, even if the price crashes 50%, it's okay because you know it's going to go higher eventually. In fact, you take advantage of market crashes to buy more and more shares as it goes lower. Because if you do, and when it rebounds eventually to its intrinsic value, you make a lot of money. So as an investor of great businesses, no matter where the share price goes in the short term, no matter how much it crashes, you are not fearful at all. In fact, you get excited, right? So like I said in part 1, investing is kind of like getting married. When you get married, the most important thing is you look at that person's fundamentals. You want to marry a person with great character, well educated, intelligent, honest, kind, hardworking. Alright, so in this video, I'll be focusing on the secrets to successful stock trading. And again, trading is a totally different game, totally different skill sets from investing. Stock trading is kind of like a one-night stand. So when you choose stocks for trading, you're not too concerned about the fundamentals of the company, right? In fact, it's only 10%. When you choose stocks for trading, you're not concerned about the fact that it's got too much debt. You don't care that it's overvalued. In fact, most of the time when I choose stocks for trading, I don't even know the business that the stock is in. And I don't care, right? In trading, we only care about the technical analysis, the short-term price movement and price action. So as long as the price movement is showing upward momentum, we buy, we go long. We want to buy high and sell even higher. If the momentum is going down, we short the stock, right? We sell high, we buy low, and we make quick short-term profits. So isn't it similar to a one-night stand, right? When you pick someone up for a one-night stand, you don't say, hey, before you go to my room, I like to check what you do for a living, what's your occupation, what's your college degree. You like to ensure you got good fundamentals, good character, you got good values. No, heck that, right? As long as the person is hot and is attractive and giving you the right signals, the momentum signals, boom, you go in for the action, right? Same thing. Now, in stock investing, remember I said we don't have a stop loss because we hold on through the ups and downs, through the good and bad times, right? But in trading, you always want to use protection, right? One night stand, you got to use protection. So in trading, you always want to put a stop loss. So the moment the price drops to a certain level, you're going to cut your loss. So when you lose, you only lose a small percentage of your capital. For example, you only lose 1% of your capital. And the moment it goes up to your profit target, you got to take profits quickly. All right. So when you lose, say 1%. When you win, say 2% or 3%. And as long as you win 50% or 60% of the time, you're making money. Because you lose less when you're wrong, you make more when you are right. Now, one of the reasons why a lot of people don't do well is because they allow trades to become investments. Never allow a short-term trade to become an investment. All right, so I know a lot of people, they say, okay, I'm going in for a trade on, say, Roku or Tesla or Beyond Meat, right? It's a trade, I'm going in for trade. And the moment it drops, what happens? They don't cut their loss. They don't put a stop loss. They say, okay, I'm going to hold, it's going to come back one day. I'm Warren Buffett. I'm a long-term investor. You can't do that. Right? Same thing in life. Never let a one-night stand become a long-term commitment. All right, it's not the right kind of person you want to bring home to your parents. Because remember that certain kind of stocks like Roku or Beyond Meat or Tesla, they are not meant for investing. They're only meant for trading because they've got high levels of debt. They're overvalued, right? But you only want to invest in companies that are really, really safe. Like for example, Amazon or Nike or Procter & Gamble or Nestle that are very, very predictable in the future. All right, let's get down to it. So, what are the secrets to successful stock trading? Okay, so the first question would be what to buy. What kind of stocks make good trades? Swing trades? Well, it depends on your strategy. There's so many strategies. Basically, you have got trend continuation strategy and counter trend strategies. And I teach all of them in my course, but I'm going to focus on trend continuation strategies for this video. So when you're trading with the trend, you want to only focus on high momentum stocks with the strongest upward momentum in the market. So when you buy, there's a highest probability you'll continue going up. So how do I identify momentum? The first thing I look at would be stocks with the highest relative strength. What does it mean? Now, there are about 8,000 stocks in the US market, and research has shown that 80% of the gains that the market makes comes from the top 20% of the stocks at any point of time. So in other words, I only want to focus on the top 20% of the strongest performing stocks in the market. And the way to measure it is using an indicator known as relative strength. So when a stock has high relative strength, it basically means that this stock is performing stronger than the rest of the market. And I'm going to show you in a short while the indicator I use to identify high relative strength in a short while. Number two, high momentum stocks need to have volume. So I'm looking for stocks that have at least 200,000 shares traded per day minimum. But of course, if you can trade a few million shares a day, that's even more powerful. Third, we want a catalyst. And the catalyst is always earnings or sales growth. So when a company has got earnings growth and sales growth that drives people to buy and the price to move up with momentum. So let's take a look at the charts right now. All right, so let me show you the indicator. I'm using Think or Swim, and I'm going to look for the relative strength indicator. So that's relative strength over there. Now, bear in mind that relative strength is different from RSI. RSI is something completely different. Relative strength measures the stock's price performance versus the S&P 500. I'm going to click OK. So you can see that this stock AMD has high relative strength. Now, how do I know? On this indicator relative strength, you can see this blue line, all right? Now, below the blue line, you can see this red horizontal line over here. So whenever the blue line is above the red horizontal line and the blue line is sloping upwards, it tells you that this stock is stronger, is performing better than the rest of the S&P 500. So you can see it's sloping upwards and it's above the red line. So I only trade stocks with this high relative strength. Another one would be, for example, Adobe, right? So Adobe has high relative strength as well. There you go, right? So currently it's above the red line and it is sloping upwards. So Adobe is performing better than the rest of the S&P 500. Let me show you a stock with weak relative strength. So example would be, say, GE, General Electric. Let's take a look at GE. There we go. So you can see that GE, the blue line, which is the relative strength, is below the red line, right? And it's sloping downwards, which means that this stock is underperforming the rest of the market. So we want the strongest performers. Got it? All right, great. So example would be AMD. Now, at the same time, we said we want stocks with high volume as well as earnings growth. So there are many websites you can use One of them could be Finviz, for example. All right, so look at AMD. Does it pass this criteria? So I like to look at the earnings for the next year and earnings for the next 5 years. Either one, I want to see earnings growth of at least 15 to 20% growth. You can see the earnings growth next year is 46%, and the next 5 years is projected to grow at 35%, which is way beyond the 15 to 20% minimum that I'm looking at. Next, how about volume? Look at average volume. The average volume of AMDs is 81 million shares traded per day. So this is a high momentum stock. Next, if I'm trading with the trend, it's really important that I only select stocks that are in a strong and clear uptrend if I'm going long, and a strong and clear downtrend if I'm going short. So how do I identify a strong trend? Well, really simple. Let me show you a weak trend, okay? Now, the first thing is take a look at this first stock, right? Now, look at the price action. We call this choppy price action, so there's no clear trend. And if you take a look, you notice that the price doesn't respect the moving averages. It goes above the moving average, goes below the moving average, and the moving averages are kind of like crisscrossing each other. So you never want to trade stocks with choppy price patterns. And certain stocks are always like that. Certain stocks are like that during certain periods of time. Like for example, during the market crash recently, many stocks have choppy price patterns. They are not tradable. So as a trader, we must be patient to wait for the choppiness. Like the waves are choppy, you don't go out, boating or sailing. You wait for the waves to go into the right rhythm, okay? So we only trade when we see the right stock exhibiting a clear trend like that. Now, this is what we call a tradable stock in a tradable market. So why do we say that this is a strong and clear trend? Here are a few clues. Number one, notice that the moving averages are arranged in sequence from the smallest moving average to the biggest moving average. Now, different people like to use different moving averages, and there's no magic behind it, right? I just happen to like these moving averages for this strategy. So you can see the first moving average, the blue dotted line, that's the 18 moving average, okay? The blue line is the 50 moving average. The orange line is the 100 moving average. The green line is the 150 moving average, and the last one is the 200 moving average. So notice that when this stock is in a very clear uptrend, what happens? The moving averages are arranged in sequence from the smallest to the biggest. Can you see? The 18 is above the 50, which is above the 100, which is above the 150, which is above the 200. That tells me the trend is very, very clear. But on the first example, can you see that the moving averages are all over the place? They are crisscrossing each other, so the trend is not clear. You never want to trade in a choppy market for a choppy stock. Next, notice that on a clear trend, the moving averages are respected. What does it mean? See, on an uptrend, moving averages act as dynamic support levels. So on a clear trend, every time the price comes down, it will find support at the moving average. In other words, it hits the moving average and it will bounce off the moving average. So as you can see over here, this stock, every time it goes down, what happens? It hits the moving average. Let me just zoom in a bit. Can you see that? All right. So it hits the moving average, pump, reverses up. Goes down, hits the moving average, reverses up. Hits the moving average, reverses up. So the moving averages are respected by the stock. We only want to trade these kind of stocks. Now, there are about 8,000 stocks in the US market. Do you think all the stocks meet all these criteria every day? No. At any point of time, again, less than 1% of all the stocks will meet these criteria. So some of you may ask, how do you find these stocks every day? How long does it take you? It takes me no more than 20 minutes to find these stocks every day. How? I use customized proprietary screeners. So in my trading community, my students will get all these screeners that we run every day, and the screeners will automatically look for these stocks with high momentum, and we focus on these stocks every single day. This is called our daily watch list. But again, knowing what to buy in the watch list is not good enough. Step 2 is we must know when to pull the trigger. We must know exactly when to buy at what price level. So to help you to understand when to buy, understand that a stock doesn't go up in a straight line or doesn't go down in a straight line. How do stocks move? They move in wave patterns, and they are made up of impulsive wave up, corrective wave down. So a high momentum stock will move in this way, right? So wave up, wave down, wave up, wave down, wave up, wave down, and the pattern continues till the trend ends. So I always like to say that it's kind of like a breathing pattern. During the impulsive wave up, it's like breathing out. So imagine you're breathing out, right? You breathe out. Can you breathe out forever? No, you're gonna run out of air. So eventually, after breathing out, you have to breathe in, right? Breathe in, and once you've taken a deep breath, then you breathe out again. So that's how prices move for momentum stocks. So question, as a trader, you want to get in and get out for profit, right? So question, where do you want to buy? Where's the ideal point to buy? Do you want to buy during the breathing out? Do you want to breathe, or do you want to buy over here, let's say at A, or do you want to buy at, say, B, where it has just breathed in and you get in before it's breathing out? Which one do you want, A or B? Obviously B, right? You want to get in at B so that the moment you get in, it starts to move up. You've got a lot of profits to capture. Does it make sense? But if you get in at, for example, point A over here, it moves up slightly, you don't get much profits, and then boom, it goes down and hits your darn stop loss. So you always want to enter after a breathing in. After a corrective wave, you enter at the start of an impulsive wave. Does it make sense? Now the question is, how do you know that this is the end of the corrective wave? How would you know? How would you know that it's not going to go lower, right? How do you know that the corrective wave has ended and it's the start of the impulsive wave? Well, there are no guarantees in trading, but there are ways that we can guess with high probabilities. And one way is to look at support levels, right? So this is what we call the high probability level of reversal. And we look at buying at a strong level of support. Now, what creates a level of support? Number one would be moving averages, right? So I look at the moving average like so. And again, when the price goes down and it hits a moving average, again, it can be any moving average. It could be the 80 moving average, 50 moving average, 100 moving average. It just has to hit one of the moving averages. And the moving average has to be previously tested to be a strong support. I'll explain that more in a short while. Okay, so that's the first thing that we look at a moving average support. Next, we can also use what is known as Fibonacci retracement levels. If you have no idea what Fibonacci is, please type Adam Khoo Fibonacci. There's a whole video on learning about Fibonacci. Fibonacci is basically a mathematical formula that helps us to determine the level of support. All right, so based on mathematics, it has been found that during an impulsive wave, right, A to B is the breathing out wave. And if A to B is 100%, then the corrective wave would usually correct to 38.2%, 50%, or 61.8%. These are the key Fibonacci levels. I repeat, 38.2%, 50%, and 61.8%. Personally, I only like to use the 50% and 61.8% Fibonacci level. So in other words, when I see that the price hits a moving average that has been tested before, and it is a Fibonacci 50% or 61.8% level, I know there's a high probability of a support and it's going to reverse. But wait, there's more. I also look at candlestick patterns. Again, if you've got no idea how to read candlestick patterns, type Adam Khoo candlestick patterns. There's a whole video on candlestick patterns, right? So I'm looking for a certain candlestick pattern like a bullish engulfing pattern or a bullish pin bar pattern that indicates high probability of price reversing from that level. Again, I'm going to show you the chart in a while, so hold your horses, right? Next, I'm looking at certain indicators called oscillators. And the indicator needs to help me or needs to tell me that the price has been oversold on a short-term basis. You see, the market is kind of like a rubber band. When it goes down too fast, it snaps back up. Goes up too fast, snaps back down. So the stochastics tells me when the rubber band is overstretched to the downside, it's going to snap up. All right, so putting everything together, right, we get this. Ta-da! Right. So this is an example of a trade I took some time ago on Zebra Technologies. And first and foremost, does the stock meet our high momentum criteria? Yes. Why? Because it's on a clear uptrend. How do you know? Look at the moving averages, right? The 18 moving average above the 50, 50 above the 100, above the 150, above the 200. Moving averages are in sequence, right? So it's a clear uptrend. Next, do we have a clear pattern of an uptrend? Are moving averages supported? Yes. So notice every time, right, breathe out, breathe in. Breathe out, breathe in. Whenever it breathes in, the price will hit the moving average. Can you see it respects the moving average? It hits the moving average, it goes up, hits the moving average, it goes up. So it's respected. Okay. So for this particular stock, where did I enter? I entered at this point over here. Right above this candle. Okay, so why did I enter over here? Well, let's run through the list over here. So notice, breathe out, breathe in, breathe out. So as it's coming down, right, as it's retracing, I'm waiting for it to hit a level of support. In this case, it hits the 50 moving average, which is the blue line. Okay, now is the 50 moving average a strong support? Yes, because it has been tested recently to be a strong support. So it has to be tested before. There we go. Next, is this a Fibonacci level? Yes, it is, right? Remember, A, B, C should be a 50% or 61.8% level. So this is what we call point A over here, goes to point B, and then goes to point C. So notice point C is, ta-da! It is the Fibonacci 61.8% level, which means that the retracement has ended with a high probability. Next, we are looking for a candlestick price action reversal pattern. And this happens to be what we call a bullish pin bar. That's right. Even though it's red in color, it is a bullish pin bar because it's got a small body and a long lower shadow. Again, watch my videos on candlesticks to understand this in detail. Next, at this level, is the rubber band low enough that it's going to snap back? Yeah, we look at stochastics. So look at this stochastics indicator. You can see every time it goes below 30, right? Can you see this is the 30 level? Every time it goes below 30, it would snap back. It would snap back. So at this point, when the price hit the moving average, you can see the stochastics went below 30, which means it's oversold. Which means at that point of time, the probability of the price going up is a high probability. Right, by the way, this strategy that I'm showing you is one of over 7 strategies that I teach my students in the professional stock trading course. And some of my strategies are swing trading strategies, some are day trading strategies. Some of them are trend continuation, some are counter trend reversal strategies. So this happens to be a swing trading strategy that trades with the trend, all right? And I call it the bounce swing trading system. So exactly where do we enter the trade? Well, here we are. These are the entry rules. So we will place a buy stop limit order a few cents above the high of the candle pattern. Now, some of you may ask, what's a few cents, right? So roughly I would say, if it's below $50, you can use 3 cents. Between 50 to 100, 5 cents. Be above $100 stock, you could use 10 cents, right? All right. So let's take a look at another example. This is PEGI. And notice that this is a trade setup. First of all, high momentum stock, clear uptrend, moving averages in sequence, and the price is respecting the moving average. So you can see the price goes out, breathe in. So this is the corrective wave. So notice as it goes down, how do we know it's the end of the corrective wave? We wait for it to hit a level of support. Boom! It hits the 100 moving average, which is this orange line. So the moving average acts as a support level. How do I know it's a strong support? Because recently, the 100 moving average was tested before. It has to be tested recently to be a strong support. Next, it is also a Fibonacci retracement level. This is the A, this is the B, and the C, which is the retracement, is 61.8%. Ta-da! It meets the criteria. Okay. Next, we're waiting for a bullish confirmation candle. So in this case, we have got this big bullish candle that appeared that confirms that the corrective wave is over. It is now reversing upward, right? So we have got this big bullish candle to confirm the reversal. Now, at this point, when it hits the support, notice that stochastics is also below 30, which means it's oversold, rubber band is overstretched, going to snap up, all right? So where do we enter the trade? The moment we see this confirmation candle, which is the bullish candle, we place our buy order. So recall, we place the buy order a few cents above the high of this candle, right? So just above the high, about 3 cents above the high of the candle, it would be there, about $23.05, just above this high. So we have a buy stop limit order of 23.05. So this means that the next day, if the price goes above the high of this candle, it will trigger the buy order and we're in the trade. But the next day, if the price doesn't go above the high, the price goes down, our trade is not triggered because it is a buy stop limit order. So that's when we buy. Now, question is, when do we sell? So recall that for investing, there's no stop loss, there's no profit target because it's a great company, we hold it through the ups and downs. But in trading, the moment you enter the stock, you have to place a stop loss and a profit target simultaneously. Okay? So where do we place our stop loss? We can place our stop loss a few cents below the swing low. So what's a swing low? Remember, right? Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. These are what we call swing lows. And these are what we call swing highs. So this is the current swing low over here, as you can see. And we'll place our stop loss just below that swing low. So ready? There we go. Our stop loss would be just a few cents below that low at 21.55. So think about it. We're going to enter the stock at 23.05. Correct? We're going to put a stop loss at 21.55. So what is our risk per share? In other words, if the price were to go down and hit our stop loss, how much will we lose per share? Well, you take 23.05 minus 21.55 gives you a risk per share of $1.50. So every share I buy, I'm risking $1.50 loss. I call this my 1 hour distance. So always remember in trading, you have to know what is your 1 hour. R refers to your risk of your trade. In this case, my risk is $1.50 per share. Got it? Okay, great. So if it goes to 21.55, I exit with a loss. But if I'm right and the price goes up, I must exit with a profit. Where do I place my profit target? I always want to take profit when my profit is double my initial risk. So if I'm risking $1.50, then I want to take profit at 150 times 2, which is $3. There we go. So 1R is my risk, 2R is my potential profit, which is in this case $3. So $3 plus 23.05 gives me 26.05. That's where I place my profit target, because I will take profit at 2R above my entry level. So is that all there is to successful trading? Not at all, not even close. The next thing is the most important thing, in fact. It's even more important, which is to know exactly how many shares to buy. We call this position sizing. Now listen carefully. As a trader, you may take many trades a week, a month, a year. And every time when you take a trade, you must always risk a fixed percentage of your balanced capital. All right. And my suggestion is to always risk 1% of your capital on any trade. 1%, that's it, 1%. Okay, especially if you're a beginner. Now, if you get more confident, you get more aggressive, the highest you should go is to only risk 3% of your capital on any single trade. So for the purpose of this example, let's imagine you risk 2% of your capital on this trade. So how do you calculate the number of shares to buy for each trade you place? Well, there's a formula. This is the formula, right? Listen carefully. The number of shares you buy is equal to your percentage risk per trade, which for example is 2% in this case, right? Multiplied by your capital, your balanced capital, whatever it is. It could be 1,000, 10,000, 10 million, right? So say it's $5,000, all right? So what is 2% multiplied by $5,000? It is $100, okay? And then you take this $100 and you divide it by the risk per share, which is the 1 hour distance. Now, if you're a bit confused, don't worry. Here's a real life example. All right, let's take a look at an example over here of this trade. So let's imagine you're taking a trade where you're buying, right, at 622, for example. You place a stop loss at 589. So what's your 1 hour distance in this case? Your 1 hour would be 33 cents. Your risk per share is 33 cents, which is 622 minus 589. All right, so 1 hour is 33 cents. 2 hour would be 66 cents. That's right, risk 1 to make 2. So our profit target would be 66 cents plus 622, 688. All right, so this is the trade setup. So how many shares do we buy for this trade? Let's use our formula. Now again, let's assume that you have a balanced capital of $5,000 and you decide to risk 2% per trade. Now again, once you decide on 2%, it has to be consistent for every trade. Or it could be again 1% if you want, right? Then be consistent, okay? Now, so we calculate the number of shares to buy would be, right, your capital, 5,000, multiplied by 2%, that's $100. Make sense? Which means the most that you can lose is $100. That's your total risk. But each share you buy, you're risking 33 cents. So how many shares can you buy? So you take the total risk, which is $100, divided by the risk per share, 33 cents, gives you 303 shares. There you go, ta-da! That's how you calculate the number of shares to buy. So your total position size would be 622, which is your entry price, times 303 will be 1,884, which means out of $5,000, you would use up 1,800 to take on the trade. But again, your risk is not 1,008. your risk is $100 because of your stop loss being there. All right. So in other words, if this happens to be a winning trade, if it goes up and hits your profit target, you would win 66 cents times 303, and that will give you $200, which represents a 4% gain in your capital. But if it's a losing trade, hits the stop loss, you will lose 33 cents times 303 shares, you will lose $100, which represents 2% of your capital. So notice that every time you place a trade, you're risking 1 to make 2. In this case, you're risking 2% to make 4%. But if you risk 1%, you make 2%. If you risk 3%, you make 6%. It always has to be this case. Now, in the professional stock trading course, not only do I teach my students all my stock trading strategies, but they also get all the proprietary customized screening software. They will screen for all these trade setups every day. At the same time, they also get this customized position sizing calculator that will calculate all these things for you, right? So for example, your account size is 5,000. You're risking 2% per trade, like the example, and we entered at 622, stop loss at 589, profit target at 688. Boom, and ta-da, it tells you the number of shares to buy. So this automates the entire process. Really simple. Now, some people ask me, Adam, hey, with all your fancy indicators and moving averages and Fibonacci, you can predict the price is going up. Why do you place a stop loss? Well, always remember this, no one can predict where the price will go in the short term. All we can do is to guess with probability. So I'm here to tell you this. As a trader, no matter what strategy you use, no matter what magical indicators you use, you cannot be winning all the time. Impossible. In fact, as a trader, on average, you will only win on average 50 to 60% of the time. 40 to 50% of the time, you're going to have losing trades. And let me tell you that if you can get a 60% win rate as a trader, you are among the best traders in the world. Most professional traders I know would sell their grandmother for a 60% win rate, right? But like I said, it doesn't matter. Why? Because your trading plan should always be that when you enter and it hits your stop loss, you lose 1R. When it hits your profit target, you make 2R. So for example, if you are risking 2%, you should make 4%. You risk $1 to make $2. And if you do that, even if you're right half the time, you will make a fortune in the markets. Let's take a closer look, right? So let's take, for example, that you do, let's say, an average of 20 trades a month, okay? And if you have a 60% win rate, what does it mean? That means that you're gonna have 12 wins and 8 losses, right? And each time you lose, say 2%. So that's 8 multiplied by minus 2, that's minus 16%. And each time you win 4%. So that's 48%. So the wins with the losses, you would get a net gain of 32% return a month at a 60% win rate. Like I said, these are the best traders in the world, right? So don't dream of getting this until you're really experienced. So let's be a bit more realistic. Let's say you get an average of 50% win rate. You're right half the time. So expect 10 wins and 10 losses on an average of 20 trades. So again, when you lose 2%, you win 4%. That still gives you a net profit or net percentage gain of 20% return a month. That's pretty darn good, right? Now, but what if you only get a 40% win rate and say out of 10 trades, you lose 6, you only make 4. Is that possible? Of course it's possible. It's called bad luck, right? It does happen at times, right? So at a 40% win rate, you're winning 8 trades and losing 12 trades. But again, each time you lose 2%, you win 4%. That still gives you an 8% return a month. So you can see that in trading, your win rate is not the most important thing. Your win rate can suck. You can get less than half right, but you can make good income if you control your risk to return ratio. That's the most important thing in trading. All right, it's been a pretty long lesson, so thanks for sticking with me. I hope you've learned a lot, but let me summarize this entire lesson, part 1 and part 2, the difference between investing and trading. I do hope you've got a very good idea right now. So remember that for investing, we focus on business fundamentals, the business behind the stock. But for trading, we don't care about the business. We don't give a darn what the business is doing. We only focus on the price action, high momentum, low momentum, right? In investing, we want to buy low and sell high. We call that value investing or value momentum investing. In trading, we don't mind if it's really overpriced, if it's overvalued, because we can buy high and sell even higher, right? We want to catch the momentum. I call this the greater fool's game. In trading, even you buy a stock expensive, you're a fool, that's fine, as long as you can sell it to a bigger fool who will buy it from you at a higher price and you make money, right? In investing, we do not use stop losses. We believe in the company. So the more the price drops, the more we buy. We average down because we know eventually it's going to go higher because it's a great business, right? But in trading, it's a one-night stand. In one-night stands, right, you got to cut your losses fast. The moment the mood is gone, cut your loss, get into another stock, right? So you have clear stop losses, clear profit targets. Leave the next morning, don't stick around, right? In investing, our win rate is 95 to 100%. You choose a good company, you hold long enough, you always win in the end. But in trading, your win rate, because it's short term, is at the most 50 to 60% win rate. Sometimes even less than 50%. It doesn't matter, right? Still make money. In investing, it's lower frequency, right? We buy and sell less frequently, so there's less time and effort. But in trading, it's high frequency, more effort, more time needed. It's more active income, okay? Investing, our time frame is medium to long term because we are holding the company to increase double, triple, quadruple over time. In trading, we get in and out very fast, in weeks, sometimes in days. Day trading in days, swing trading in weeks, sometimes in months when we do trend following. All right, cool. So if you want to learn more, remember, subscribe to this channel and join us in our stock trading courses or value momentum investing courses where you join our private Telegram chat groups at piranhaprofits.com. I'll be seeing you soon. May the markets be with you. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.